If you're waiting for the headline to tell you that the market has changed, you're already behind. Because this week, nothing looked dramatic, no change, no crash, no panic, no breaking news, but underneath it all, the market has shifted. But not in one place, across everything. The bond market quietly repriced real estate, GDP came in flat, affordability is getting worse, even though inflation says otherwise. Government stepped in with incentives, institutions are buying differently, distress is showing up, but not how people expect. And even AI made headlines. Individually, you would ignore these, but together, this is how exactly the market transitions. Hey Smarties, welcome back to another episode of Smart Real Estate by LearnInvestManage.com. I'm your host, Addy Saeed. And today's episode is one of those where if you really understand what's happening, you're ahead of most investors because this isn't about reacting to headlines. It's about reading signals before they become obvious. Before we get into it, I want to know where you're at. Are you actively looking to buy right now, or are you sitting on the sidelines waiting? Drop a comment, send a message. I read them all, and I actually shapes what we cover next. Let's start with the most important piece. And honestly, it's the one that most people are missing. Apartment values dropped this month, and nobody announced it. Over the past month, 5-year Canada bond yield jumped about 50 basis points, and most investors, they don't react to that. But they should, because multifamily real estate is priced off the bond yields, not Bank of Canada's overnight lending rate. Let me translate this into something real. On a $10 million deal, that move adds roughly $40,000 in debt service. At a 5 cap, that's between $700,000 and $800,000 in value. Same building, same rents, lower value because money got more expensive. And here's what I'm seeing in real time. Deals are falling at financing. Loan proceeds are shrinking and buyers are retrading. But sellers, they're anchored in yesterday's pricing. So the question to ask is, are you underwriting based on today's debt or what rates looked like last year? Because that gap, that's where deals fall apart. Let's zoom out. Let's talk about the economy. The most dangerous market isn't a crash. It's actually a stall. RBC this week showed that GDP is flat. Manufacturing is down 3.9%. Wholesale is down 1.5%. And housing activity is weakening. Real estate prices are still sliding. But at the same time, retail spending is still positive. In February, slight rebound, but nothing strong. So what does this mean? This is not a recession. This is not a recovery. This is a stall phase. And stall phase are tricky because there's no urgency on the buyer, no forced selling for the seller, and no strong growth, just pressure building quietly. On the ground, here's what I am seeing. Deals are taking longer. Buyers are hesitating and sellers are holding firm. And you see this in property pricing and even listings. Last week, we reported that the active listing have gone down 3.8%, and new sales are also down 1.9%. What does that mean? You have buyers that are pulling back and sellers are also pulling back, and it's creating a gap in the marketplace. So, do you think that this turns into a soft landing, or are we just delaying the real correction? RBC came out with a report about the affordability illusion. Here's where things are getting a little bit more interesting. The data says people are doing just fine, but the market says that they're not. On paper, inflation was at 2.4%, wages grew 3.8%, so technically, people should be ahead. But reality, housing costs aren't properly captured. Mortgage costs are excluded. Financing pressure is ignored. So what happens? People feel worse off, even the data says otherwise. So there's a shift. Affordability and no inflation is the driving behavior. Why does it matter? In today's market, buyers are having a hard time qualifying. Investors are seeing thinner margins and demand is weakening around the edges. So what does that mean? It means that you're going to have less transactions that are going to be taking place. Couple that with sellers that are not expecting their expectations or not adjusting their expectations, we have a market that is stalling. Markets don't move based on data. They move based on pressure and wherever the pressure takes it. So, question for you is, do you feel affordability is improving or getting worse right now? Because what people feel drives what people do next. Here's a government signal for you. Let's talk about policy. So when the government steps in like this, it's not a solution. It's usually a warning. So Ontario introduced up to $130,000 HST rebate on new homes. Sounds great, right? But let's look deeper. What it actually is, it supports pricing. So current pricing that the developers have, it supports that. It helps developers move inventory that is locked up right now. And also, you have to remember, all this money, investor money, is tied up in this inventory that should be invested in other ventures, but it can't be because there's no buyers available for this. And also, so they're trying to bring buyers back so that they can keep these projects alive. What this rebate does not do is fix the construction costs. It does not improve rental economics, and it does not solve the affordability in the long term. So this is stabilization. This is not a solution. What this tells you is that inventories are building. Developers are under pressure and the correction is being managed, not avoided, which means that it's just getting delayed. Do you think this helps buyers or is it really helping developers survive? Another article that we talked about is institutional moves. Now here's where smart money shows its hand. Institutions aren't waiting, they're adjusting. We're seeing a $1.3 billion fund buying unsold condos, and they're targeting to buy about 2,200 condos all across Ontario. And they're focusing mostly on the more urban areas. Why does this exist? Because inventories are rising, closings are failing, and developers need liquidity in today's market. If you recall, a couple of weeks back, we talked about LGM, which is a developer that ran into trouble even after their project has closed. LGM had 55 units left, 43 units came back because buyers weren't able to close, and 12 units were on part of the unsold inventory. My numbers might be a little bit off, but at the end of the day, they had 55 units that didn't sell. And because of that, they had post-closing illiquidity. And they were insolvent because they actually had liens registered on those condos, so they weren't able to sell them. So to avoid problems like those, the government is stepping in and making funds available for private buyers to come in and buy these units. Now, those buyers are not able to close because they're buying it at full price. Versus what you're seeing right now is institutional buyers buying those same condos. Let's compare this. So retail investor would be paying full price. They would have negative cash flow on these, and they would have tight financing. Institutionals coming in, well, first of all, they're doing a bulk discount. So these guys are looking to buy 10 plus assets, 10 plus units per building, and they're probably going to get 15 to 30% below their marketed price. They're looking for a discount on this. They're going to have structured financing with mezzanine debt, and also the debt is backed by a Building Ontario fund. So they're going to be able to qualify for a much higher and longer amortization. And it's a CMHC optimization. They're also using affordability component, which means that 40 to 50-year amortizations are definitely on the table for these guys. So it's the same asset, completely different outcome. So these guys are looking to purchase about 2,200 units, and they're using government funds to back their purchase up. Would you rather compete with these institutions or understand how they're actually playing the market? Understanding them will actually help you get further ahead than to try to play that game. So let's talk about something most people still aren't seeing clearly. There's this $1.1 billion deal that wasn't growth, it was survival. Ravelin, which used to be Slate Office REIT, had a default on debt. They had $600 million in forbearance. Their occupancy was at less than 75% or 74.7%, and they were facing serious restructuring pressure. Then Clark steps in. What happens next? There's equity. So initial investor equity got diluted to around 16%, and lenders effectively take control. Now, one thing that I should point out, when I made this video, I had a couple of people reach out to me and they were actually not happy. I believe that they were actually part of the original investor group, and they weren't happy because the main guy at Clark was also the main lender for the REIT, and they basically went in and pressured the REIT into accepting the deal that they have offered. And this is how distress shows up for projects like these. There's no crash, there's no headline, but you do get massive recapitalization, you get dilution, and you get quiet restructuring. So equity doesn't appear overnight, it just gets diluted slowly. So my question to you is, how many deals like these do you think are happening quietly right now? And the next story that we have is about AI selling a house in Florida. And finally, let's clear something up. ChatGPT didn't replace a real estate agent. The market did the work. So the story was the seller used AI and listed their property 100K over estimates and sold it quickly. And everyone says, hey, AI is replacing real estate agents. The reality, it was a pricing bet. It was a strong demand environment with real buyers in the marketplace. AI didn't create demand. AI didn't close the deal. AI didn't take the risk. What it did do is increase the confidence. And here's the problem. Confidence works in strong markets. It fails in weak ones. So would you trust AI to price your largest asset in the market? Be honest. Let's bring this all together. Every signal this week points to one thing. Pressure is building. We got rising cost of capital. We got stalling growth. We got affordability pressures. We got government intervention. We have institutional repositioning, and we have early distress showing up. This does not create a crash. It creates a slow, uneven repricing cycle. And the biggest problem right now, it's not the market crashing. It's not realizing it already started to change. So here's what I want to hear from you. Are you preparing for the shift, or are you waiting for confirmation? If you want me to break down real deals I'm seeing in the market right now, drop deals in the comments and send me a message, or book an appointment at addysaeed.com. Or if you want to go deeper, check out notes on our website. Join the community where the real conversations are happening. The final goal of this show is simple: to help you learn, invest, and manage with confidence and clarity. This podcast is for informational and educational purposes only. Nothing discussed should be considered financial, legal, tax, or investment advice. Real estate investments involve risk, and past performance is not indicative of future results. Always consult a qualified professional before making any investment decisions. Any examples discussed are for illustrative purposes only.